Welcome back to U.S. Farm Report. On the roundtables with me this week, Don Rose of U.S. Commodities and Matt Bennett of Bennett Consulting. We're going to switch things up just a little bit and start off with livestock. This week, cattle prices last couple of weeks had some decent trades. What's supporting prices right now, Matt?
Well, I think cattle were oversold for the most part. I think, with most of our producers, we looked and where they had floors set in place from earlier in the year, we said, let's go ahead and take profit on these and maybe move these down just a little bit, because the bottom line for us is that it looked to us like maybe things were getting a little bit overdone for the time being. I do think that there could be more weakness on down the road, but I think for the time being, we'd overdone it enough to where we could see just a little bit of a bounce.
So Matt sees weakness down the road. Do you think here short term maybe we found a bottom?
Well, it looks like again time that we put in a good seasonal low here short term, but we still have a lot of supplies we have to deal with in the fourth quarter, 5% over a year ago. So when you get into 105 to 108 on December cattle with the supplies of protein that we have coming at us in the fourth quarter, those will probably catch up risk management opportunities across the even into the second and third quarter.
So Matt, heading into 2017, what concerns you the most with this cattle market?
Well, I think our numbers are still more than adequate, and I think a producer has to stop and think, what's the upside in this market? Whenever they look at what their cost structures are, a lot of guys are telling me that if they protect cattle in this 104, 105 area, a lot of them can still do okay. And several of them have been able to buy cattle just a little bit cheaper in the last couple of months than maybe what they thought they were going to earlier, but we've been very strongly encouraging them to keep floors under these prices.
Don, this hog market, I mean, we're looking at, not enough slaughter capacity and some other things pressuring prices. I know we saw a decent week, but some analysts think that we could be going back to a situation we saw in the 1990s with these pork prices. Is it that bad?
Well, the good news, Tyne, is I think that we've talked that up so aggressively, and we've dialed in that big slaughter pace going down the road, and really what we need to do is move back from the 6 to 8% slaughter that we had down to where the government estimates are 2 to 4%. And I think you have to remember the government in the fourth quarter said that the price was going to be $48 to $50, and we're trying to move back into that level. So I think what happened is we just got too negative, too early, and we are finding a dead cat bounce right now, but we'll probably have some risk management opportunities as we're sitting right here going out at the end of the week.
But we need China. We need China to need our pork. Do you think that happens, that continues?
Well, and that was one of the big stories that we had in the middle of the summer, early summers, that the Chinese were going to aggressively buy pork, and they were pretty aggressive, but they backed off. Even this last week, they've been very slow on their purchases. It doesn't look like they're going to show up anytime soon, but Mexico's been a strong buyer, and our exports do have to pick up if we're going to expect to hold these prices.
Speaking of demand, some impressive demand out of China for soybeans. I mean, this demand picture seems to just keep getting better and better. Is that what's supporting these soybean prices as of late?
Well, I think here lately, the world vegetable prices have definitely been a huge catalyst. Whenever you look at, for the U.S. producer's standpoint, the real has actually gained on the dollar a little bit. And so, as far as our beans on the world market, they've been quite competitive. Yes, Chinese demand is phenomenal. I think that this week's export numbers were largely expected. And one thing I think on down the road is if we do have a really large crop out of South America, I don't want to think that maybe our exports are going to stay as strong all the way through the year as what they did last year. So I'd be just a little bit cautious, but they've been great to this point.
Don, this is the second time this year that a soybean rally has kind of caught us off guard. Not a lot of people were talking about it and advertising it. So are we learning anything from this?
Well, yeah, that's a good point. I think really what happened is I think what we're doing is adding some risk premium to the market. The trade did get caught off guard with weather problems in South America in March. And again, we're starting some rain issues in Argentina just as we're about to start planting soybeans, planting corn right now, 40% done. So I think we're adding some risk premium to the market, whether we need it or not. It's going to depend on the La Nina if we get into some weather issues down the road. But when you're at $10.20 on this November beans, over $10 on next year beans, we need some weather problems if we're going to maintain or move higher from this level.
So is this soybean rally, is this market today a little top heavy? We'll ask Matt that when we come back, as well as look at this corn market. What's going on with corn right now? We'll do all of that when we come back on U.S. Farm Report.